Dear friends, let's look at the concept of risk and return. We have all heard of these two terms in our lives, but what do they mean from a financial perspective? Now, we are going to look at the concept of risk and return. We are going to look at risk in a single investment. We're going to also look at risk and return in a portfolio context. And we will look at the relationship between risk and return. Now, let's look at the term return first. What does it mean? The return from an investment is the realizable cash flow earned by its owner during a given period of time. Typically, it is expressed as a percentage of the beginning of period value of the investment. Let's look at this illustration. You buy a share of the equity stock of Olympic Limited for rupees 80 today. After a year, you expect that a dividend of rupees 2 per share will be received on that stock, and the price per share will rise to rupees 90. So what is the expected return on your investment? So the expected return can be computed as 2, which is the expected dividend per share, 2 rupees, plus 90, which is you expect the price per share to rise to 90, minus the current price of the stock of Olympic Limited. The whole thing divide by 80, you get 18 by 80 is equal to 15%. So the return on your investment of 80 rupees is 15%. In general terms, the rate of return is defined as K is equal to D subscript T plus PT minus PT minus 1, the whole thing divided by PT minus 1, where K is actual expected or return or required rate of return, PT is price of the security at time T, PT minus 1 is equal to price of the security at time T1, and DT is income receivable from the security at time T. By the way, before I go ahead, I'm going to share a link in the description box below where you can get a copy of these material that I'll be sharing with you today. I'm going to put a link and you can download these material. So don't worry if you think that I'm going fast. You don't worry, you can have a look at these the material later on. Now, so we have seen what is the return, right? We have seen the concept of return. How do you calculate return? That return is expressed as a percentage. Now, let's look at the concept of probability. Now, the concept of probability is very important when you calculate risk and return. Because what is probability? The chance, right? Chance of occurrence, or the chance of something not happening, or the chance of something happening. Probability. Now, when you buy an equity stock, you are aware that the rate of return from it is likely to vary and often vary widely. For example, if you buy a share, by the way, that is SHARE, right? Okay, sorry about that. That is share. If you buy a share of Olympic Limited for rupees 80 today, you may be confronted with the following possible outcomes as far as the price after a year is concerned. Now, in the previous illustration, we say that after a year, the price per share will rise to 90. Now, is there a certainty? Is it certain that the price per share will rise to 90 rupees? No, it is not certain, right? It is uncertain. So therefore, when you always deal with the future, you're dealing with uncertainty. And so even here also, when you buy a share for Olympic Limited for 80 rupees today, you are confronted with possible outcomes after a year. What will be the possible outcome? A, let's say there are 3 possible outcomes: that the price per share will rise to 90 rupees. B, that the price per share will remain the same at 80 rupees. And C, that the price per share will rise to 100 rupees. Now, all the 3 outcomes may not be equally likely. All right. Now, The first outcome, for example, may be more likely than the others. In more formal terms, we say that the probability associated with outcome A is greater than the probability associated with the other outcomes, B and C. So the outcomes, all the three outcomes may not be equally likely. You may have a 50% chance that the price per share will rise to 90. You may have a 30% chance that the price per share will remain the same at 80, and also a 20% chance that the price may rise to 100 rupees. So if you look at that, the outcomes of these three happening is not equally likely. It's different. The probability of an event represents the chance of its occurrence. For example, an investor says that there is a 4-to-1 chance that the market price of a certain stock will rise during the next fortnight, in the next 2 weeks. Now, what does that mean? This implies that there is an 80% chance that the stock 80% chance that the stock will increase, and a 20% chance that it will not increase during the next fortnight. This judgment can be represented in the form of a probability distribution as follows. Possible outcomes and probability. Stock price will rise, 80% chance, 0.8. Stock price will not increase, 20%, 0.2. So what is the total of that? You know that the rule is that the sum of all probabilities of a certain event is equal to 1. It cannot be less and it should not be more than 1. So the sum of all probabilities should be equal to 1. Let's look at this illustration too. Consider investment in two equity stocks. The first stock is Bharat Foods, may provide a rate of return of 15%, 20%, or 25% with certain probabilities associated with them based on the state of the economy as shown in the table below, in this table. Okay. The second stock, Oriental Shipping, being more volatile. What do you mean being more volatile? It means not steady at all. The second stock, Oriental Shipping, being more volatile, not steady, not stable, may earn a rate of return of minus 20%, 10%, or 40% with the same probabilities based on the state of the economy as shown below. So this table will show the rates of return and the probabilities for Bharat Foods and Oriental Shipping. State of the economy. You have three states of the economy. One is the boom period, which is, business is booming, everything is going well. Then you have the normal, and then you have the recession where things are not going that well. Then the probability of occurrence, 0.3, 0.5, 0.2. And if you add all these, you'll get 1. Always remember the sum of all probabilities should be equal to 1. Then the rate of return expressed as a percentage. For Bharat Food, 25% during boom period, 20% during normal period, 15% during recession. Now for Oriental Shipping, which is more volatile, during the boom period you make 40% return. Then during normal period it's only 10%, and during recession you actually make a loss of 20%, minus 20%. In defining the probability distribution, the following points should be noted. The possible outcomes must be mutually exclusive and collectively exhaustive. The sum of the probabilities assigned to various possible outcomes is 1. See, I told you that the sum of the probabilities assigned should be equal to 1. So we have seen what is return so far. We've seen what is probability. And now let's look at another very important concept, which is expected rate of return. Now, when the rate of return can take several possible values because of investment risk, it is common to calculate the expected rate of return, a measure of central tendency. So the expected rate of return is defined as K bar is equal to summation Pi and K. Okay, here has to be N period and I, small I, is equal to 1. All right, where K bar is the expected rate of return, P subscript I is probability associated with the ith possible outcome, and Ki is the ith possible outcome, and N is number of possible outcomes. Okay, N is number of possible outcomes. Now, how do you calculate the expected rate of return? Okay, for Bharat Food and Oriental. Now, we have seen in the table that they have 3 possibility of occurrence, right? 0.3, 0.5, the probability of occurrence is 0.3, 0.5, 0.2. And the rate of return is 25%, 20%, and 15%. Now we need to find out what is the expected rate of return of this. This is nothing but, for Bharat Food it is KB, expected rate of return. All right, let's say K bar B is equal to 0.3, which is a probability that there will be a 25% rate of return, 50% that the rate of return will be 20%, and 0.2 that the rate of return will be 15%. So you calculate, add, you'll get 20.5. And for KO, this is for Oriental shipping. Okay, so the expected rate of return for Oriental shipping, KO, is equal to probability 0.3 into 40% plus 0.5 into 10% plus 0.2 into, no, minus, remember the rate of return of Oriental shipping during the recession is minus 20%. All right, so minus 20%, and you get 13%. So that is how you calculate the expected rate of return. Now the expected rate of return is very important because without the expected rate of return, you will not be able to calculate the risk, which is defined by standard deviation. I will explain to you. So far we have seen return, we have seen the concept of probability and expected rate of return. Now let's look at risk. And what is risk? Risk refers to this dispersion of a probability distribution. How much do individual outcomes deviate from the expected value? A simple measure of dispersion is the range of possible outcomes, which is simply the difference between the highest and lowest outcomes. A more sophisticated measure of risk employed commonly in finance is standard deviation, which we are going to find out. Now the standard deviation is calculated as sigma. You know this sign, whenever you see this sign, sigma, this is standard deviation. All right. Now how do you find out standard deviation? Standard deviation is equal to summation of Pi into Ki minus K bar. What is K bar? Is expected rate of return, okay, to the power 2, okay, and the whole thing to the power half, okay, 1 by 2, which is nothing but what? Which is nothing but square root of summation I is equal to 1 Pi into Ki minus K bar to the power 2. So that is standard deviation for you. Okay, where sigma standard deviation, okay, and so on. Now let us calculate the standard deviation. Okay, let us calculate the standard deviation for Bharat Food and Oriental shipping. Okay, here's the problem. Now let's do this for Bharat Foods first. State of the economy. Ki, you know what is Ki? Ki is nothing but the rate of return. Ki minus k bar. Okay, we have to find out, and we have to also take the square of ki minus k bar, pi probability, which is already given, and so on. Now let us first find out what is, let's write the probability first. What is probability given in the problem? Here it is. All right. What is the probability? That there will be a 25% rate of return, it is 0.3. That there will be 20% return, 0.5, and 15% return, 0.2. So let's write that here. Zero 0.3, 0.5, 0.2. All right. Now, first thing is we need to find out what is k bar. So what is k bar? We have seen. So k bar is nothing but summation of n pi into ki, right? So we have already calculated what is the expected rate of return. What is expected rate of return? We have already calculated for Bharat Food. So the expected rate of return for Bharat Food is here. We've already calculated it is 20.5. 20.5%. Now, let's find out what is ki minus k bar. So 25 minus 20.5 is equal to 4.5. 20 minus 20.5 is equal to minus 0.5. And 15 minus 20.5 is equal to minus 5.5. Now take the square of this. That is 30.25 0.25 that is 20.25. Okay, now find out what is pi into ki minus k bar square. So 20.25 into 20.25 into 0.3 is 6.075. 0.25 into 0.5 is 0.125 and 0.2 into 30.25 is 6.05. Take the sum of this. Okay, remember we have to find out the summation. Pi, sorry, that is pi into ki minus k bar. So what is the summation of that? $12.25. All right. So now find out the standard deviation. Sigma is equal to square root of summation Standard deviation is 3.5. Now this is for Bharat food. Now remember, the higher the standard deviation, the more risk involved. All right. Now this is for Bharat food. Now let's calculate for Oriental shipping. Same thing, same procedure. Now we know what is the probability. Remember, it's already given. What is the probability for Oriental shipping? Probability that will be a 40% rate of return is 0.3. Probability that will be a 10% is 0.5. Probability that there will be a minus 20% is 0.2. So 0.3, 0.5, 0.2. Alright. Then let's find out first what is K bar, expected rate of return. Pi into Ki, which is already calculated. We've already found out, remember? Okay, there. Okay, K bar for Oriental shipping is 13%. 13%. Now find out what is Ki minus K bar. So 40 minus 13, 27. 10 minus 13 minus 3 and minus 20, okay, minus 13, so that is minus 33. Okay, take the square of that, will be 1089. All right, and then there'll be 9 and 27 times 27 is 729. Okay, now 729 into 0.3, which is equal to 218.7. Then 9 into 0.5 will be obviously 4.5, and 1089 into 0.2 is 217.8. Find out the summation of this. Is 441. So find out what is the standard deviation. Sigma is equal to square root of summation n standard deviation is 21. All right, now if you compare these two, if you compare Bharat Foods 3.5 standard deviation and Oriental shipping 21, which one do you think has more risk? Obviously Oriental shipping, because if you look at the returns itself, they're so volatile compared to Bharat food. All right, so this is how you find the standard deviation. We will continue again in the next video. I will show you some other thing else. I'll show you how